Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor. I'm finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Financial Review.
And we are the Money Café. Not in the cafe this morning, but let's just pretend there's hubbub behind us. And we'll be back in the cafe next week, I'm sure.
Yeah, virtual cafe today.
Virtual cafe. Got a coffee in front of me. And, James, can I just say that you've been on fire lately? Your columns have been great.
Oh, that's very kind of you. Thank you.
Yes. I was interested in a few things you've written lately. One of them was John Mott at the Banking Summit. Now, in general, what was the Banking Summit like? Yeah, was it a summit? Do you reckon?
Yeah, it was a summit. No, it was interesting. I mean, I think the banks have had a tough couple of weeks, right? We have the CEO of NAB, Andrew Irvine, there. I think that stock is down like 20%. Since February 13, which is not something we're used to seeing with the banks. They've had such a great run. And all of a sudden they find themselves a little bit on the back foot. I mean, I don't think there's like bad things happening inside the banks. They're still in pretty good shape, but we've just seen this really interesting change in sentiment around the banks as I guess we've seen, lots of change in sentiment around everything at the moment.
Is NAB down the most among the banks?
NAB is down the most, yeah. Yep, that's right.
Why would that be?
Oh, look, I think they'd run pretty hard, and their first quarter trading update, so the December quarter, was arguably the weakest. Now, when I say weakest, I think they missed their, the market's expectations for net interest margin by 1 basis point, which is 0.2 of stuff all, and they still managed to. They're still being whacked by the market. So it's just that mismatch of expectations and reality, I guess. But so it was an interesting summit against the backdrop of that, and as always, we saw the topic of housing dominate. For those of you who don't know, John Mott is a veteran bank analyst and at Barrenjoey, which is an investment bank. And he has sort of long been concerned about the idea that really banks are lending mainly to rich people. So he had some great stats about 8% of credit in Australia is going to households with $120,000 of income or less. So that's roughly 60% of the population. But more credit, 9%, is going to households with more than $500,000 in income who are investors. So we're seeing the banks favour, naturally, because that's where the demand is, but they're favouring wealthy investors, and the poorer households, for want of a better term, that can't get into the market are being left behind.
But did he say what could be done about that, if anything?
Well, not much. But his argument was you need to look at this as the bigger picture of this, and we've got some questions later about a good question about how has, I think it's from Lachlan, who asks Lachlan's dad asks is trying to figure out whether the risk weights that have been applied to the banks, so the amount of capital they need to hold against each loan, has made a difference, because the amount of capital you need to hold on against a mortgage is half the amount of capital you need to hold against a business loan. So where have the banks concentrated on? They've concentrated on mortgages, because
that makes lending on housing much more profitable for the banks, obviously.
Much more profitable
because capital is expensive.
That's right. But to be fair to the banks, they're also being told that that's what they should do by the prudential regulator. They're being told that mortgage lending's a lot safer. So what's happened? The banks have gone nuts on mortgages and far less nuts on business loans. It used to be back in the 80s that 2/3 of lending from the banks went to business and a third went to housing, roughly. Now that's totally switched. And John Mott's point, he made a couple of great points, but one of them was, we're all worried about this productivity problem. Guess who drives productivity? It's businesses, but they can't get as much credit as they once did.
Yeah, so I read your column reporting on what John Mott said, and my my palm hit my forehead because I didn't talk about that aspect in my quarterly essay about housing.
Yeah.
And I think it was absolutely right. Of course it is. I mean, I did talk about how the banks have become loan marketers rather than loan rationers.
Yes.
So, I mean, I kind of did get into that, but I didn't talk about the reason for it, which is the change. Because, and John Rott's right, I mean, there was a change in the way that the risk rating weighting works that kind of coincided with the big increase in house prices.
Yeah, that's exactly right. And then he had this sort of line that stopped the summit dead, Alan, when he said, if we don't change something about housing affordability, you won't know your grandkids if you live in Sydney. And his point was that there's no way that the generations below you are going to be able to afford to live anywhere near where you live.
Yeah, well, it's interesting because I had lunch yesterday with my sister who lives in Sydney, and she lives in Marrickville, and her daughter, who is now pregnant, has moved to Penrith.
Right.
Because that's the only place they could afford to buy a house.
Yeah.
And that's a long way from Marrickville, you know.
Yeah. And does your sister sort of that's not really pleasant, is it, for anyone?
No, that's right. And so she's going to, I mean, that's just a long journey to see her grandchild.
Yeah.
You know, and so that kind of brings home what John Mott was talking about.
Yeah. It's just he's got away with words, Moddy, and he wasn't really proposing any solutions, Alan, because I think the solutions are intractable. But his point was, we've worked so hard to make the banking system safe, in inverted commas, and stabilised.
Yeah.
But one of the outcomes is that we've just locked so many people out of housing. And is that what we really intended? Is that the outcome that we want? Is that where we wanted to go? It's a good question.
I should say I rang John yesterday to ask him to do an interview for Intelligent Investor. So Intelligent Investor subscribers who are listening, watch this space. We might get him. I'm not sure. He's got to ask he's got to ask the PR people at Orange Joe if he's allowed to do an interview. So anyway, he said he'll get back to me this morning.
Fair enough. Hopefully that comes through for you.
I thought your piece on WiseTech yesterday was very good. So I borrowed from it on the news last night because you listed at the top of the piece of the item. You listed the things that the independent review of Richard White's behaviour had found against him, and then you pointed out that not only did he not get fired. His power was improved, enhanced, and the board went, not him. And as you point out, in any other company, including little ones, he would have got fired for sure. Why don't you just run through the things that the the review found?
The review found that he I'll quote here, made inaccurate and incomplete disclosures concerning the nature and duration of his relationship with an employee. He, quote, entered into a commercial relationship where there were undisclosed conflicts between the interests of WiseTech and the personal interests of Mr. White. He, quote, failed to disclose the nature and duration of a personal relationship. I mean, all this stuff, this is an incredible story because, as you said, Alan, White I think he's come through this firestorm now. I think he's survived it. And where we get to now is that WiseTech has been left with a board of 3 people at the moment. They say they're going to get a 4th person soon. And Richard White has gone from CEO to executive chairman. So his power and control and influence over WiseTech is even stronger than it was before he went into this scandal, this series of scandals. So if you can work that one out, you're doing better than me. I mean, I thought the really interesting thing, Alan, was that the WiseTech directors have done a survey of their shareholders. And clearly the fact that White is still there suggests that investors are prepared to sort of hold their nose, look past the obvious governance problems, and keep White around because they think he's so important to WiseTech's success and profitability. I get that. That's a pragmatic place to get to. But I guess the question is, would you be worried about Richard White's judgment, given he's made all these mistakes that he's acknowledged?
Yeah, but he's promised never to do it again, right?
Yes.
I'll never do it again. I'm very, very sorry, and
Yes.
I'll never do it again.
Yeah, my line was, the board's basically told him he's a very naughty boy, but he's our very naughty boy, which I think is about right.
It does make the G in ESG a bit of a joke, doesn't it? Really,
totally.
I mean, all these sort of super funds saying that we're investing in ESG in mind, environment, social, and governance, but governance, don't worry about it.
Yeah. Well, we are until we aren't. So look, I mean, I think WiseTech shares are still 20-25% down on where they were a couple of months ago. So there's still a bit of trust to be rebuilt with the market. I think it's going to be fascinating to see where this goes. I mean, we're seeing.
Do you think it might be a buy at this level?
I don't, and the reason I don't is because you look at an example like Mineral Resources, where Chris Ellison, the founder and CEO there, went through this sort of bruising experience, the scandal around a tax scheme that he was involved in. Things haven't improved at Mineral Resources. In fact, they've got a lot worse because they've made a big stuff up building a road into out to its iron ore mine, which, despite being in a cyclone hit area, they didn't asphalt. They didn't seal the road. And so I just, often trouble begets trouble is my point. So I'd want to see a bit more water go under the bridge at WiseTech, I would have thought.
Yeah, fair enough. Fed held rates as expected last night, and they upped their inflation forecast and down their growth forecast. So, kind of, in a sense, fueling the stagflation predictions and concerns, but not exactly forecasting a recession, of course.
No, but a little whiff of stagflation there. And Alan, and in the press conference following the decision, you're not going to believe what Jerome Powell said.
What?
He used the T word, transitory. Can you believe this? I mean, 4 years ago, after the Federal Reserve and lots of other people said that COVID inflation was going to be transitory, we're still fighting it, by the way. Powell's come out and said that he thinks the inflation hit from tariffs could be transitory too. And look, the market popped on this. Between the rates decision being announced and the end of Powell's press conference, the S&P 500 was up about 1.3% because people reckon, there's no risk of rates having to go up because of tariff inflation. Because Jerome thinks it's transitory. This is a sort of big surprise to me.
Well, I've got some sympathy with that idea because a tariff is a bit like a GST, and when Australia had GST in 2000, it was definitely transitory because what happened was it just was a once-off increase in prices, and the Reserve Bank rightly looked through it at the time. I mean, the difference this time is that the tariffs are all over the place. It's not as if we just get one kind of, here's a 10% tariff or whatever, even 20% tariff, and that's it. Like there's no kind of sign that it's going to kind of be a once-off situation.
Yeah, I get your theory, Alan.
It's not a theory; it's true.
No, I get what you're saying, but what surprises me, shocks me, is that Jerome Powell, who is so careful about choosing his words and his messaging, would think it was appropriate to use that word. I mean, he's basically spent the entire press conference saying, I don't know what's going to happen and neither do you. That's why we're sitting on our hands. But hey, the tariff inflation might be transitory. Please, come on, Jerome. Just wait and see what happens before you shoot your mouth off, I reckon.
Yes.
Particularly with that sort of loaded word. But anyway, market's got a little bit of relief after a tough couple of weeks, so that's good.
I tell you what, there's a lot going on though, isn't there? Really, it's hard to keep
unbelievable. It is unbelievable. Like you know, just in the middle of the week, and most people in Australia would be whatever, but this decision in Germany to release the debt brake, as it's called, and basically rearm Germany after the US has sort of effectively pulled its security guarantee for Europe. I mean, that could change markets for decades. The process of German rearmament will take years and years and years, and the amount of money that will be spent will be huge. And that just happened on a random Tuesday night. I mean, it was unthinkable probably 3 months ago. And the pace of change is just extraordinary at the moment. It's
interesting. Our friend Victor Schvetz from Macquarie had a note this morning with the heading, "Investors are already in the 1930s." Now, Victor's been saying for a while now that investors are facing an environment like the 1930s. It's not like the 70s; it's like the 30s. And what he's talking about is that democracies atrophy, and an ever larger number of people reside in anocracies, which is a democracy stripped of its meaning, or autocracies, which is what happened in the 1930s. And with the world increasingly led by nationalistic strongmen, and so I mean, it's certainly. I mean, with German rearming is certainly a bit of an echo of that time, isn't it?
Yeah, wasn't on the bingo cards. It's been really interesting. I mean, I think Victor Schvetz is one of my favourite strategists, Alan. I think he's one of yours too, but I spoke to him just before Christmas last year, and he was so convinced that, okay, Trump won. He's talking a big game, but he was so convinced of what he called the guardrails would hold, that Congress would restrain him, that he'd be restrained by international relations, that the courts would restrain him. And I think just the way these guardrails are being skirted or picked apart or ignored, I think that's really.
I think it's fair to say the guardrails are not holding, including the courts. I mean, he's just ignoring the courts. Unbelievable.
Yeah. Amazing.
But I think that the point, what we haven't seen yet, is the bond vigilantes really coming at Trump. And I mean, Trump and his Treasury Secretary Scott Bessent are really keen to get the bond rate down. And if the bond rate goes up instead, like really up, I think that will act as some kind of guardrail. And that's something that Victor was talking about last year.
That's true. But I mean, Bessent and Trump are talking the bond vigilantes language. I mean, all of this is about getting the budget deficit down. Now, there's lots of other things, but the main thrust of the economic policy is exactly what the bond vigilantes have been calling out for years. So they're on board at the moment. They're not going to get too grumpy for a while.
Yeah, that's true. We probably better get on to questions.
Let's do it.
We've got a few good questions. We've already dealt with one of them, I think, but let's do that. Before we do, let's hear a quick word from our sponsor.
People are always trying to create wealth, but protecting wealth is just as important. Secure your financial future for yourself and your loved ones with life insurance, the essential safety net for your legacy. Head to investsmart.com.au/life-insurance for an easy free quote on life insurance options. Simply share a few details about your situation to get a range of plans and prices.
Now, first question from Rob. What are your thoughts on the current market correction? Do you think that's it, or there's more pain to come, or who knows with Trump's indecisiveness? Love the show. And to Alan, go Bombers. Yes, good on you, Rob.
Need all the help you can get there, Rob and Alan.
What do you reckon?
I'm going to do a Peter Dutton here and say I don't agree with the characterization of the question or whatever it is he says. I don't think Trump is indecisive. I think he's being extraordinarily decisive, not in a way that we particularly want. And there's lots of noise and toing and froing on tariffs and that sort of thing. But just to go back to that last point, this is about getting the budget deficit down. Everything should be seen through that prism. The stuff in Ukraine, the peace deal with Russia, that's about reducing US defense spending. The stuff about tariffs, that's about trying to grow revenue and bring the budget deficit down that way. I think this is a very sort of clear plan, yes, wrapped in lots of chaos, but just imagine for a sec if Trump is actually going to get the budget deficit down from 7% of GDP to 3% of GDP. And that means that the economy, the US economy, slows from 5% growth to 3% growth. If that's right, if he can actually do that, then we're only at the start of the repricing of assets. What we've seen now is, going to be tiny compared to what could be, because markets have got used to huge government spending and strong growth. And if those two things aren't there, there's going to be some serious readjustments on markets. So I reckon we're at the start of this process, not the end. I don't know if maybe I'm being bearish, Alan.
Well, what we didn't talk about before was the note from Macquarie Bank, not Victor Svets, on Monday, which had the headline, unless Trump, what was it? Unless Trump blinks, it's a bear.
Yeah.
And got a bit of coverage, naturally, as you'd expect. And the opening paragraph said, unless Trump blinks and pulls back from trade wars and spending cuts, which currently seems unlikely, there is a risk of a material slowing in US real consumer spending. And as this is the most consistent signal of a bear market, we see growing risk that stocks will fall 20% from their Valentine's Day peak. Now, so that's the definition of a bear market, is 20% down, correction is 10% down. So we've had a correction of 10% down, and stocks would fall, according to this, another 10%, which I reckon is not too much. I mean, if that's all you get is another 10%, that's fine.
Yeah, totally.
I mean,
I agree. I mean, we've had a couple of great years. We're handing a bit of that back at 10%, and we'd be handing a bit more back at 20%, but it wouldn't be the end of the world. And but Macquarie's hit on the point, haven't they, Alan? Why would Trump blink? I mean, I think investors have just underestimated this guy. We all think this is a big dog and pony show, and he'll back away from all this stuff. I mean, what's the evidence for that?
Yeah, no, I agree, totally agree. I mean, I don't think that. Haven't thought that. I think that. I mean, this time around, he and his people around him, more precisely, are very well prepared.
Yeah,
and they know what they're doing.
Yeah,
I think that's true.
Gordon says, thanks for the podcast highlight of the week. Thanks for helping us stay calm in these difficult times. I don't know if that last 5 minutes has been too calm. My question is whether you can imagine a decoupling of the Australian economy from the US. Our stock market seems to follow the US markets, and the dollar seems to mostly rise and fall on the actions of the Fed. Is this inevitable given the relative size of our markets, or is another pathway possible?
Yeah, interesting question. Yeah, look, it's really tied up with whether the world is going to decouple from the US to some extent. Whether Trump is successful in deglobalizing the US in general, not just sort of geopolitically but also financially. Because he's trying to get the US dollar down, which implies some sort of agreement to get that happening. So maybe they do decouple.
Yeah, we're a very trade exposed small economy, though.
Yeah, but we don't do much trade with the US.
No, we don't. But I mean, the idea that we can sort of decouple from the US, I think, would be very, very optimistic.
Well, the movement of the markets is basically, as far as I can tell, driven by the fact that the US is by far the largest market, and most of the big investors with the most money are in the US.
Yeah.
And so, and what people talk about all the time is risk on, risk off. So if there's a risk off day, which is that the investors, the traders feel like they need to remove some of their risk from their portfolios, they sell everything. They don't just sell the US, they sell the Australian market as well, which and that may have nothing to do with what's going on here. It's just the fact that they feel like selling.
Yeah.
So that's the main reason for the coupling of the markets. I mean, what should happen is the Australian market mostly follows the Chinese economy.
Yes. Yeah, that's true. We're caught betwixt and between to a certain extent.
Emily says, I'm a dual Australian and UK citizen in their late 40s who had 8 years of national insurance contributions when I moved here in the early 2000s. I've now paid back my NI to 2006 with average payment of under $400 Australian a year and qualify for part pension, and I'm on my way to qualify for a full pension. The UK pension is not means tested, and I was wondering about your thoughts on this and if it would be viable for Australia to be in some kind of universal pension outside of super that will mean that those of us lucky enough to own freestanding houses will be more incentivised to right size when the time comes. I'm not sure about the sequitur there. Is that a non sequitur? But
I'm not sure. The one thing I'd say about this, the idea of a sort of universal pension, maybe not to get too dystopian on you, Alan, but if we head towards a world where AI starts really hitting jobs, the idea of some sort of universal basic income has been pretty popular. Would that fit in broadly with this, perhaps? A non-means tested income?
Look, I think Emily's being a bit more narrow than the universal basic income. I mean, I think she's talking about just not means testing the pension, the age pension in Australia.
Yeah.
I didn't know. Did you know the UK pension is not means tested?
I did not know that, no.
That's amazing.
Yeah. Very surprising.
I mean, to be honest, I can't see the point of giving the pension to rich people, really.
Yeah. Yeah.
No, I mean,
agree.
Yeah.
I guess the UK doesn't have a super system like ours, though. So there are different conditions there that might, big differences in the way those markets are structured. If you know.
Look, on the other subject, I mean, I agree with you that as if AI results in mass unemployment, then there will have to be some sort of discussion about the level of unemployment benefits. And how that's done, whether it turns into a universal basic income that is just paid to everybody, I'm not sure. Yeah.
Yeah.
I mean, but look, my experience is that governments tend to act too late, or at least they act after if something's happened. So they will not anticipate mass unemployment. They'll react to it rather than anticipate it. So we'll have to see what happens.
All right, Aidan says, higher wages is the first factor listed by the RBA to increase productivity. Why historically then do we only aim for wage growth to match inflation, 2 to 3%? Shouldn't we aim for wages to match shares and house price growth of about 7% to encourage productivity growth? That's an interesting question too.
Yeah, well, so the simplified version of the RBA's view of inflation is that that inflation equals wage growth minus productivity. So if you get wage growth of 3%, productivity of 1%, you get 2% inflation. So that would mean that they're not going to be too happy with wages growth of 7%.
Yeah.
And inflation and productivity of like zero as we've got at the moment. Yeah. Productivity growth I'm talking about.
No, that's right. I don't quite get how we'd pull it off, Aidan, without everything getting more expensive, to Alan's point. But
yeah, so it's the problem. Yeah, look, I mean, I understand what Aidan's saying, that that one of the problems with productivity, one of the reasons that productivity has declined in recent times is that real wages have not kept going.
Yeah,
and so people don't feel like working hard or something. I mean, I think that there's a point to that, but yes, yeah. I think that 7%, matching wage growth to house price growth. Well. Yes. I mean, what we need is for house price growth to be zero for a while. So we don't want that to happen to wages either.
No. Alan, I reckon we've done Lachlan and Andrew's questions in our discussion previously about housing, so we can go to Elliot.
Yep. Elliot says, my friends and I were debating whether OPEC has been successful in controlling oil prices or not. Wondering your opinion on the matter. Also, if Trump's strategy for wealth is to drill, baby, drill, will OPEC be able to oversupply the market, driving down oil prices, making it unprofitable for the US to drill, baby, drill?
I think the US would love it if OPEC oversupplied and drove down oil prices. Elliot's right. It wouldn't. There's no incentive to drill, baby, drill under that scenario. But the US is drilling, baby, drilling like never before anyway.
Exactly.
American oil production's never been higher, so that the actual capacity for America to drill, baby, drill is pretty limited. But
Well, in fact, what removed OPEC's power was fracking, which which was the cause or the source of the big increase in American output of oil, and they became the world's biggest exporter of oil, which basically sapped OPEC's power.
So yes, Elliot, I think you've got a fair point. OPEC's success in controlling oil prices is questionable, but I think, there is talk that eventually Trump will look for some accord with Saudi Arabia, particularly, to try and force oil prices down, because that would sort of take the pressure off the drill baby drill thing, and he'd get what he wants, which is lower energy prices, which would help drag inflation down. So I think there's a bit to play out here,
Yes.
but Trump will not be worried at all if OPEC oversupplies.
No, of course not.
Darren says, in light of a shaky AUKUS security reliance pact, shouldn't our government be doing something to strengthen our petroleum reserves locally, as less than a month's worth of diesel doesn't seem a lot?
What's that got to do with AUKUS?
Oh, I'm not sure. Perhaps Darren's suggesting that if we can't rely on the AUKUS security pact, we can't rely on the free flow of oil from friendly countries, so maybe we should top up the tank, the national tank.
Oh, I see. No. Well, I think companies that have got oil are very, very keen to sell it, and I don't think there's much trouble buying oil if you want it. AUKUS, AUKUS security pact that's not well, maybe he's talking about. Maybe Darren's talking about ANZUS rather than AUKUS. AUKUS is a deal to spend $368 billion on some submarines on the Never Never.
Yeah, I guess he's saying, though, that if security alliances are not as strong as they were, is it sort of every country for themselves when it comes to strategic reserves of crucial commodities? So I get the point. I'm not sure how practical it is or how much we've got to spend on strengthening the sovereign petroleum reserve.
And Darren says also, why does the UK hold our 8 million tonnes? Is it 8 million tonnes of gold reserve in London?
I think he says 8.
Surely we haven't got 8 million tonnes, have we?
I've got no idea on that one, I confess. The only thing I could think is maybe you want to hold that gold close to the London Metal Exchange so you can sell it. I'm totally guessing there, but yeah, maybe.
Yeah, I don't know.
All right, Jay says he's a big podcast fan and hasn't missed an episode in 2 years. Neither's Alan. What are the pros and cons of buying lesser-known companies such as those in the ASX 500 to 750 list compared to the ASX 300? A company I'm interested in was listed in 2008 as a market cap of around $300 million. Its fundamentals and prospects look good. Analysts now know it. A tempting buy.
Oh, it's certainly the case that it's certainly true that not all the good companies in Australia are in the ASX 300. That's absolutely true.
Yep.
I mean, the thing about the ASX 300 is that there are ETFs around, based on the ASX 300. So when a company goes from number 301 to 299, a whole lot of ETFs have to buy it, and their price goes up. Which and I suppose to some extent the fact that it's held by ETFs because it's in the ASX 300 makes it a bit more stable and all that stuff, less volatile. I don't know, is that right?
Yes, absolutely. Yeah. You attract more index buying, and it also says that the company has more has the wherewithal to belong on the ASX 300, and I guess that's the risk that Jay needs to think about. Like, smaller companies have smaller balance sheets, less flexibility, and so you do have that sort of inherent amount of higher risk, and inherently higher risk compared to bigger companies with bigger balance sheets and more flexibility. So that's the con you've got to think about. I mean, it sounds like Jay's been watching this one for a while. It's just about your risk tolerance, how much of your portfolio. I wouldn't imagine Jay's thinking of putting all his eggs in that basket, but it might be a interesting stock to follow as a very small part of your portfolio. I think it's just a matter of getting that balance right, I reckon, Alan.
And bearing in mind that most companies in the ASX 300 started off outside the ASX 300.
Indeed, yeah.
Mason says, a couple of weeks back, you talked about the investment outlook for housing, noting that it's not looking positive given the government's commitment to increasing supply. From a retail investor's perspective, the difficulty in comparing housing to shares or other investments is the leverage you get through housing. Should we not try to incentivise more investment in shares, which should hopefully move, i.e. by better tax treatment, which should hopefully move the public perception away from housing being the best investment, and hopefully provide more capital to homegrown companies rather than fueling the housing crisis? If so, what tax treatments would work? Negative gearing for shares? Well, I couldn't agree more, Mason, except that negative gearing is already available for shares. It's just that people tend not to borrow to buy them.
Yeah.
Because they're more volatile, and and also you can only borrow 50%. Mind you, if you leveraged a portfolio of shares that didn't pay dividends, and leverage that to 50%, you'd get a fair bit of negative gearing tax deduction, wouldn't you, James?
You would, yeah. I mean, I guess shares do have pretty favourable tax treatment broadly, but yeah, there's nothing to stop this idea.
That's the other point you make is that with shares, you get franked dividends, whereas your rent from owning property is definitely not franked.
Yeah, so I think you're on the right track in a way, Mason. But we've probably tried a few of these things, and the power of property just can't be stopped. Nick says, I read about negative interest rates recently and thought, why don't people leverage differences in interest rates, borrow money from low interest rate countries and invest in high interest rate countries? I assume large investment groups do this, but why don't individuals? Is it because the banks won't lend for this reason, because there isn't collateral? Well, Nick, you're describing the famous carry trade there, right, Alan? This is exactly what lots of Japanese people do all the time, including individuals. So it's not impossible. And in fact, in some low interest rate countries like Japan, they do this a lot.
I've actually never investigated whether it would be easy for an Australian individual to borrow in Japan. Would it? Do you know?
I'm not sure. Yeah, probably not. I would have thought.
Yeah, probably not.
The Japanese have specific products that help people do this.
Yeah.
So you're buying from an institution Australian dollar exposure or something like that, for example, just as an example. So the Japanese individual doesn't have to go and do the hard work themselves, that they're presented with a product. So there might be examples of that where Australian investors can do similar, but yeah, not easy.
Probably got time for one more question. I can't resist the one from Ian, who says, greetings from Bhutan up in the Himalayas. Well, greetings back to you, Ian, in Bhutan. I must wonder what it's like up there. He says, even here there is no escape from the orange felon. How were so many supposedly intelligent people allowed to comment on markets with bunkum like Trump will be good for business without being laughed out of a job? He's a deregulator. I think that it's generally felt that deregulation is good for business.
Yeah. And again, Alan, to get back to this idea, we have had, for as long as I've been doing this, and probably as long as you've been doing it, people in markets saying the US needs to stop its addiction to debt, get the budget deficit down, rein in spending. Well, that's sort of what Trump is doing. Now, you might not agree with the way he's doing it, and it could create a big shock for markets, but he's actually doing what a lot of people have said and a lot of politicians have promised and done nothing about for many years. I mean, yes, there's a lot of stuff around that that's pretty gruesome and pretty brutal, and the way that guardrails are being, jumped over or ignored or chipped away at is clearly worrying. But the thrust of what he's trying to do from an economic point of view is sort of what people have been asking for a long time, isn't it?
And I must say, just to add to that, I think that the idea that tariffs are good for business is a load of rubbish.
Yeah.
I mean, most American businesses import a lot of parts.
Yeah, totally.
So their costs are going to go up. It's not going to be good for business at all.
Yeah.
It'll be good for some American-based manufacturers, but I reckon American-based manufacturers have got far more problems with what's going on in China than can be dealt with by a bit of a tariff.
So I think Ian's right. A lot of this stuff isn't good for business. It's not going to make the lives of business easier. Maybe the tax cuts and deregulation, if and when we get to that, will be helpful. But the sort of the bargain Trump is trying to make, and Scott Bessent, the Treasury Secretary, is quite open about this. We are prepared to have a bit of short-term pain because we think the goal of getting the budget deficit under control is worth chasing. So that's I guess that's the sort of trade-off that Trump's working through at the moment. Yeah,
correct.
For business, probably not. Definitely not in the short term. But Trump and Bessent are saying it will be good in the long term if we can get this right. So it's a fascinating experiment.
It is, and I'm just glad we're watching it from a safe distance.
Yeah. Although it didn't, when the S&P was crumbling and the ASX was following, it doesn't feel too safe or too far away at times. That's for sure.
Fair point. That's good. Thanks everyone for listening to today's episode of the Money Café. I'll be back next week with Stephen Mayne. Send in a question to themoneycafe@eurekareport.com.au. Until then, I'm Alan Kohler, founder of Eureka Report and finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.